Welcome to the YouTube channel of Michael J. Swanson. Michael is the author of How David Beats Goliath and is the CEO of Advocate Capital. And now, here's Michael.
Hi everybody, Mike Swanson here, speaking to you live from Nashville, Tennessee at the headquarters of Advocate Capital. Today's webinar is being brought to you by Advocate. We are the purveyors of the AdvoTrack Case Expense Funding Service, and we help hundreds of law firms around the country get better results for their clients. So today's webinar is the 10 most common forms of capital for contingent fee law firms. And much of today's content is based upon a book I wrote called How David Beats Goliath. It's the only financial training book that's ever been published to help plaintiff lawyers. But we also are drawing from our years of experience being in the marketplace every day. In fact, joining me today in the studio is our Vice President of Strategic Solutions, Jeff Glueck. Jeff, thanks for being here.
Hi, Mike. Good to be here.
Yeah, likewise. So Jeff has a team of 8 full-time consultants in the market every day who are conversing with clients and prospective clients throughout the country. So we have that wealth of knowledge to draw upon as well. So we're going to get started today. As I mentioned, this is me. I am the President and CEO of Advocate, and this is Mr. Jeff Glueck. And Jeff works with hundreds of law firms nationwide. So we'll get started. These are the 10 most common forms of capital for contingent fee law firms. They range from fee sharing to loan with interest pass-through. And what we'll do is touch on each of these, talk about advantages, disadvantages, and relative economic costs not accounting for risk abatement. So let's get started by thinking about this list. Jeff, when I speak to folks around the country, I will ask them, what do you think of these as the least expensive and which is the most expensive? And they're usually surprised about what is the most expensive. What do you think it might be?
Well, I think most firms don't look at fee sharing in the light of being an expensive form of capital. They're not necessarily looking at it from a overall borrowing or equating it to a borrowing cost.
Right.
But when you equate it that way, I think a lot of our viewers may be a bit surprised in terms of what they're giving up and how much it actually is costing them.
Yeah, absolutely. So there are some positives to fee sharing, right? There's no collateral required, no UCC. You could have bad credit, and there's a lot of comfort because you're normally dealing with another law firm. But the biggest negative really is the high potential financial cost. And the effective annual interest rates, if you do the math, can be as high as 150% per year, which is a big eye opener. So we have an example for you to look at on fee sharing and how the cost can be high. So this is an example where the total settlement or verdict is $100,000. The typical 1/3, 2/3 split in terms of the client getting 2/3, the law firm getting 1/3. So if you think about it, if you were to take this case in and then share it to another law firm, primarily because you don't have the $10,000 needed to prosecute the case, let's think about what you're really giving up for that and for how long. And let's assume this case takes a year, right? Mm-hmm. So what are you really giving up? Well, let's think about interest for a moment. First of all, what is interest? Interest is when you rent someone else's money because you don't have what you need, so you rent someone else's money, you're paying interest. Well, in this case, what are you giving up? You're giving up half your fee, which in this example would be $14,850 in exchange for using someone else's $10,000 or the benefit of that $10,000 for a year. So when you do the math on that, the effective annual interest rate in this example is actually 148.5%. So that's usually an eye opener, right?
It is. And, we look at fee sharing and we try to advise a firm relative to fee sharing. It's a little like cooking with dill. A little goes a long way. Certainly to be able to minimize and protect your own money certainly is in our client's best interest.
Yeah, absolutely. Of course, there are benefits to fee sharing sometimes. You may be tapping into the knowledge and experience of the other law firm, and you also may be getting the labor on their side, and there's some risk abatement because they're accepting some of the risk there, but it can be economically very expensive. The flip side to fee sharing, as expensive as it can be, think about for a moment, if you're that other law firm and you're getting a case referred into primarily for the economics of it, what's your return on your investment, right? You're putting in $10,000 and making $14,850 in return in a year.
Yes. Yeah, it's a pretty good deal. And a lot of times a client will fee share because they don't have the bandwidth to go after the case. So they're looking for someone to share the workload.
Sure.
And we try to advise a client, hey, it's always best if we can figure out how we can get you to a place where you can hire more staff so
Yeah.
that you can keep more of these cases in-house.
Exactly. So you're not referring it out because it's
Yes.
very high economic cost for doing that. Fantastic. Let's talk about the next type of capital, Jeff, and that's contingent lenders. And these are also referred to as non-recourse lenders. Are you seeing those in the marketplace right now?
We are, and it's a really expensive cost of capital. I think a lot of law firms are enticed by there's a transference of risk where the lender is taking on the risk of the merits of the case. And we have heard clients tell us that, hey, I've got the use of their money, and they're maybe not so focused on, well, when I'm successful, because I'm only choosing cases I know I can win. Right? When I'm successful, maybe they're not thinking as closely about, well, how much is that money going to cost me at the end?
Yeah. I'm also seeing this contingent lenders or non-recourse lending being done quite a bit in the area of mass torts.
Yes.
Where someone goes to mass tort made perfect, and you have these contingent lenders there. Sometimes they're hedge funds or private equity funds, and they get paid to put tens of millions of dollars on the street, and it can be kind of intoxicating that someone's going to give you $10 or $15 million. It's not recourse to you personally, it's only recourse to the cases. So, that may or may not work out. It depends upon how long the torts take, right? And how long that interest rate clock is ticking, because the costs are typically very high. You can expect to pay, I've seen, anywhere from 50 to 150% effective annual interest rates.
Yes. And you're disclosing a tremendous amount of information to the lender. We're seeing these lenders pop up. The more and more venture capital that's out in the marketplace, there's a lot of companies, the stock market's strong, they're making a lot of money. They want to monetize their earnings, and we're seeing a lot of these lenders pop up. Yeah. And certainly the firm has got to sacrifice a lot of information for them to evaluate the merits of that case.
I think a one-off case to get chips off the table or ameliorate some of the risk can make sense, or if it's a basket of mass torts. But to run an everyday, all-day contingent law firm and fund all your cases that way, boy, you're giving up a lot of money.
Well, and a little does go a long way.
Yeah, absolutely. Great. Let's talk about appeal funding. That used to be a little more prevalent. We're not seeing as much. I think there may be only 2 players in the market that are doing appeal funding.
Fortunately, this is a segment that we're not seeing a lot of activity, at least with the clients and firms that we're actively speaking with. So it is expensive, and thankfully it seems to be maybe taking a back seat to some of the non-recourse players in the market today.
Yeah, it's quite a bit of a niche, right? I mean, this is when a law firm gets a verdict and it gets appealed by the defense. And they have to go fight that, or maybe they've appealed it. And so it's very nichey. The only 2 players that I know of in the marketplace are lawyers. They'll go in and really evaluate that claim. It is typically non-recourse, so it can be a way to maybe partially get chips off the table. If you have $100 million fee that's out there on appeal, hey, maybe you want to get $100,000 off the table and you're willing to pay $100 to do that. I mean, so that can be a way of getting a few chips off the table.
Sure.
It's very much a niche product. All right, let's talk about settlement funding next. Obviously, it's when the law firm has settled the case, typically have a signed settlement agreement. What types of firms are using that product?
Well, there's a firm that may be a little bit more cash strapped. Maybe they are experiencing a lull in overall revenues. They tend to ebb and flow. We understand that, and they're looking for, hey, I have won my case, parties have signed. I don't want to wait for my money. I want it now. Yeah. And they're willing to pay that 2% per month or so to have access to that money. We advise a client that we look at this more of it's kind of like a payday loan type situation where they're leveraging future revenue or future income that they haven't received yet. Kind of like if I went down to the pay cash and loan and my paycheck's hitting in 2 weeks, but I need the money now. I'm certainly going to pay a premium for that money to get that up front.
Yeah, I mean, what they're basically doing, right, is they're reaching in 90 or 180 days into the future and pulling the benefits into the present because they need the cash that badly. We do see firms, you and I both know firms that kind of get addicted to that because they're running their cash so tight. So if you're having to pay, 25 to 45% cost of capital, you're probably doing something wrong. Once in a while, maybe, but if you're a serial settlement funding law firm, you might want to look at your business model.
Yes, and when that settlement does come in, and you've got to immediately take a chunk of that and surrender it because you've already had access to it, in addition to the finance costs that it costs you to have access to that money or to rent that money, as you said earlier. I could see how that would be a little bit of a downer when that settlement when those checks actually came.
Right. How much of your annual revenue is going to interest carry? And if you're addicted to settlement funding, probably a lot of it.
Yes.
Yep,
Yes.
absolutely. All right, next would be finance company loans. And as you and I know, because there are capital constraints for contingent fee law firms generally. So, for example, I'm one of the owners of Advocate. If I want to grow my law firm, firm even faster, I can go out and sell stock, right, for growth capital. Have investors that will share pro rata in profits and losses potentially with the investment. But that's not available for law firms, right? Only a lawyer can own equity in a law firm. So that's one of the challenges lawyers face. They can't just go out and sell stock. And so these finance companies, non-bank finance companies have popped up over the years to kind of fill that gap of growth capital. And I call it quasi-equity. One of the problems I've seen is that debt is not equity, right? So equity, if you sell equity, your investors are going to share your pro rata in your losses and your gains. Well, if you have a secured lender that's a finance company loan and you treat that as growth capital and you burn through that, well, guess what? Your secured lender is going to get paid, and often paid before you do.
Yes, and I think we've seen firms that have gotten enticed by the size of credit line these finance companies would be willing to write to the law firm. And they're able to get to that amount of line size because that company is usually owned or employs a bunch of lawyers, and they're evaluating future value of cases. And it can be an enticement much similar to the prior example that we talked about, where evaluating the future value of cases, hey, I haven't realized that revenue yet. And at the end of the day, do I want to lever long-term debt based upon the future value of those cases? And very often we have firms that come to us and they're begging us, please, can you help me? Because the lion's share of my gross revenues are going to servicing this debt long after the goodness that I've experienced when I spent that money.
Right.
Can you help me? And the fact is that very often we're not able to help because that firm, unfortunately, is over-levered with that finance company.
Sure. And as you know, we often see income statements for folks who are with one of these expensive lenders. They'll show us their income statement and apply to become our customer. Often we can't help them. What we do see sometimes is that the lender is making more money off of the law firm than the partners are, which is really sad. Yeah,
and it's very sad. And there isn't a shortcut to growth. We found that firms, they want to grow very aggressively, and we think that's great. We want to grow very aggressively along with them. There is a time and a place and a natural progression of that growth. And when a firm gets overly aggressive with regard to their growth, it can get them into some trouble.
Right, absolutely, makes sense. So the rates we're seeing, 14 to 25%, depending upon the lender out there. These are just a kind of a vanilla loan, but they're a secured loan by accounts receivable. Let's talk about credit cards next. Folks might be surprised to see credit cards on the list.
Hey, people are enticed by miles and points and all that good stuff, and take a close look at if you're not paying that balance in full every month. What's the actual cost of that mile that you get for every $5 that you spend?
Sure.
It again, a little goes a long way with regard to credit cards, and it's expensive money.
It can be. And in the last financial crisis, which many of our viewers maybe have forgotten about by now, we saw some things happen with credit card issuers that were kind of caused a downward spiral in people's credit situations. So if you read the fine print in many of these credit card agreements, the bank has the ability to draw down the line size, the size of the credit card limit, unilaterally and without even notifying you. So what we saw happening as the crisis happened and banks are starting to conserve capital, if somebody had a $5,000 balance on a $10,000 credit card, the bank would maybe want to limit their exposure and lower that limit to $6,000. So instead of now being 50% utilized on their credit, now they're upwards of 70 or 80% utilized. And when that happens, Jeff, we saw credit scores go down, even though people had not missed a payment.
Because all of that compression happens, and it kind of fools the credit scoring models and algorithms into decreasing a score.
Right.
Because you're all of a sudden, when your credit line is taken from $10,000 to $6,000 and you had a $5,000 balance, the utilization percentage goes through the roof through no fault of the cardholder or the law firm. And it's unfortunate.
And something else in the fine print of these credit cards is that they can increased your interest rate, many of them, to 29.99% if you miss one payment. And so, your significant other forgets to mail that check on time, you can see the rates on all your cards, because now you're cross defaulted, go up to 29.99%, and your monthly payment probably doubles. And
good luck getting a decision maker on the phone when you want to talk about it with your credit card company.
No, they require mandatory arbitration, right?
Yes.
They're not going to give you your day in court. Absolutely.
Yes, exactly.
So I use a credit card. I happen to have adult children who live around the country, and so Tracy and I use a Southwest card. We like the points, but we pay it off every month.
Yeah. Well, there's a difference between using it for groceries or using it for an expert witness.
Yeah, absolutely. Let's talk now about partners cash. And this is, I think, by far the most common way that most contingent fee law firms fund their practice, mainly their case expenses. And I think it's been out of inertia that's been done. Is that most common what you see out there as well?
I think a lot of firms, they get into the business, they want to help people, and they come in and they come out of school and they're on fire. They want to help as many people as they can. And it is kind of, hey, what I have to do in order to be able to, it's kind of the status quo. I know that I'm getting into this, and I know I've got to self-fund my cases, or I'm going to use cash within the firm itself or the partners until I get there. And we see it almost like a little bit of a rabbit trail.
Yeah, absolutely. And it's funny, I think when I talk to lawyers, sometimes they say, well, I self-fund my practice because I'm risk averse. And I kind of chuckle a little bit, because I can't think of a more risky place to let my after-tax cash sit than in my law firm's cases that are going to turn over and over and over and over again, where I have no control on it, right? Bad things happen to good people. Law firm partner gets disabled, starts to wind down a little bit. Those case expenses come back out and are used for operations.
Yes.
And people, we see it. Law firm employees embezzle from law firms for sometimes. So
it's very sad. We've had a few cases of that recently, and it's very, very sad.
Yeah.
And it's one of those things where the more a firm can protect their after-tax cash, and place it somewhere that isn't their mattress, and get it out of harm's way, I think that they'll reap benefits long-term, because at least they'll know that no matter what happens, my cash, my capital that I've worked hard for, is in a place that's safe and protected.
Yeah. So I think the safest place for law firm partners' cash is in their own personal FDIC insured bank account outside the law firm.
Yes.
Let's talk about the time value of money a little bit. Jeff, the Federal Reserve Bank has decided they want a 2% target on inflation for whatever reason, whether you agree with that or disagree with that. Some of that affects the buying power of the cash that you have, right? And this graph we're showing here kind of shows you the time value of money, the value of cash invested at 0%. So if you had $1 million and you were getting a 0% return, which is what happens when you put in your case expenses, after 20 or 25 years, the buying power of self-funding, the buying power of $1 million has dropped dramatically. What kind of house could $1 million buy 25 years ago? Right.
A pretty big one, I think.
Even in most markets. And now $1 million house in San Francisco is a 2-bedroom shack.
If you're lucky.
Yeah. So getting that. So there are hidden costs, and as you know, I have a YouTube playlist and also a webinar on the 9 hidden costs of self-funding your case expenses, which we can get into if you want to get into more detail on it. All right, let's move on to vendor financing. Folks may not have considered this as a form of financing cases. What's your experience been?
Well, I don't know that we necessarily identify this when we're speaking with the law firm, but we know that it happens. And we know that they're looking for that net 30, net 60, net 45-day type arrangement from when they are engaging or hiring a resource for a case versus when they're actually paying it. So we don't have necessarily a good feel in terms of what that vendor would charge, but it is another thing for the firm to keep track of. And it is one of those things that, well, geez, if you happen to miss that payment because our clients are very busy and our viewers are very busy, and it's quite easy to lose track of, geez, can't believe I forgot to send that $5,000 check to that witness or that expert, and
Right.
are they going to show up now
Right.
when I need to depose them or get them into court?
Yeah. So, vendor financing should only be done with the vendor's permission. Should be something pre-negotiated, whether it's extended payment terms, or some vendors in our industry, as you know, will work on a contingent basis. So you might have an expert witness
Yes.
that says, instead of writing me a $10,000 check, I'll get paid in the back end.
Sure. And, we found, and going to trade shows, the experts and the resources that would be willing to extend payment are typically the ones that are either new entrants to the market. They're trying to build a client base,
Right.
and they may not be the best quality or the best choice relative to the resources or the expert or the tool that the case needs,
Right.
Because they're probably in much more demand, and they'd
Absolutely.
be less likely to be able to or be willing to vendor finance.
Right. So the ability to hire the very best vendors is going to affect your practice and the results your client has.
Yes.
Yeah. So
we want our clients choosing the very best expert because they're the best expert, not because they have the most favorable payment terms.
absolutely. Well, let's move on to a bank line of credit. That's something pretty much everybody's familiar with.
Yeah.
Many law firms have a bank line of credit. It's familiar. It's not that expensive, although it has been going up, right? So for 7 years, the prime rate was 3.25% because they were trying to stimulate the economy since the last crisis. But in the past 3 years, it's been going up. Let's see, December 15, it was moved up the first time. So 3 years ago now, they started inching it up. It's now up to 5.25, and they're signaling they're going to increase it some more. So if you do the math on that, prime at 5.25 now is 70% more expensive than it was if I did the math right. It was 60%, but it's a lot. Serious signal, double-digit increase in the net cost. So if you have a line of credit for your law firm, you're seeing that item on your income statement every month go up and up and up, and it's going to go up more. So it's not quite as inexpensive as it used to be.
Yeah, well, there's margin compression. The contingent fee that our clients get is fixed. It doesn't get the rise with the prime rate.
Right.
So their profit margin is being compressed, particularly if they're reliant upon a bank line of credit for either financing their advanced case costs or getting them through a slow period from a working capital perspective. And there's very little the firm can do unless they can stroke a check and pay their balance in full. There's very little a firm can do to protect themselves in a rising interest rate environment for them to have control over exactly what their fixed costs are.
Right. One of the other things that you and I are aware of is that many banks require a clean-out period where once a year the bank requires the line of credit to be paid to zero for maybe 30 days. Now, the banks do that because they don't want to feel like this is an evergreen loan. It's just a short-term loan, and it's not equity. They don't want to feel like it's equity. But the problem with that, as we all know, is that if you're a successful law firm, your case expense balance almost never goes to zero because you're turning cases over. So a bank line of credit sometimes can be a bad fit for case expenses because where do you instantly come up with the cash to pay your line to zero for 30 days? So that can be a bit of a conundrum.
Well, a bank will write a loan across multiple industries, right? So they're doing commercial lines and commercial loans for just about, go to any small town in the country, and whether it's a building, they're financing various industries. We all know that when a law firm is growing, the amount of expenses that they need to pursue the cases is also growing.
Right.
So a bank doesn't understand that when a law firm is up against a credit limit, that's actually a positive sign of growth. That law firm is taking on more and more cases that they need to fund and finance the advanced case costs for. And so a bank, the alarms may going off, and they may be saying, hey, this is a credit risk because there's too much of an over-reliance on this line of credit, and we need them to pay it down to zero to demonstrate that, well, we actually don't need this money. And a lot of times our clients can't do that.
Well, in defense of banks, I have to say, the most powerful person in a bank is the chief credit officer because they can say no. And really when a banker who's a sales rep brings a deal into the credit team, if it's a big enough deal, the credit team's going to say, well, what happens if this deal goes sideways? And if the only collateral the bank has is accounts receivable, the banker says, well, we get all these great cases that are signed up. And the chief credit officer says, let's just put a lien on their house.
Yes, and in fact, I was speaking about a customer with our chairman just yesterday, and they had lunch, and they had mentioned that they had a bank line of credit, and it was for $1 million. And it turns out the bank had $7 million worth of real estate collateralized, in addition to an active UCC against the firm's accounts receivable. So for that $1 million line, they had likely more than $8 million worth of collateral. It's a lot.
Yeah, absolutely.
Because the bank doesn't understand the value of a firm's accounts receivable.
Because they wouldn't know what to do if they had to foreclose on it. They know how to liquidate a home or a car or whatever else, but what do I do with these cases? They have no idea. So when they really think it through, they put no value on it, and they put it on maybe the personal guarantee or other things. Let's talk about the last example today, which is a loan with interest pass-through. And full disclosure, this is the category of product that Advocate Capital provides. So the AvalTrack Case Expense Funding Service is a loan with interest pass-through. And in most jurisdictions, if a law firm incurs debt specific to a case for case expenses, and if the technology is in place to track that case by case to the penny, that third-party expense, just like any other expense, can be passed through to the case. So that's mainly what we do, right, Jeff?
Yes, and our goal is to consult with the firm and really work out a strategy to provide them with the lowest cost of capital possible. All firms are different, all needs are different. Where we have an opportunity to consult with and speak with a firm where, hey, if there's agreement that, yes, I'm supportive of passing borrowing cost on, the very first thing that we want that firm to do is we highly recommend that they update their fee agreement language that would disclose and allow them to pass borrowing costs through to the cases. And where we have that in place, the cost of capital that we provide, and there's a difference between the interest rate and the net cost to the firm. Those are two very different things. Where we have a pass-through model, our net cost will be 4 to 5 times cheaper than if that firm were using a bank or other source of capital to fund those advanced case costs.
Right, because we pay banks off all the time when we welcome new clients. I think we signed up about 90 new clients and funded them last year. I think we're on track to do about that amount. And oftentimes when we're closing these loans, we're paying out banks because we have the technology that they don't. So you mentioned the fee agreement language. So for those of you watching, check your fee agreement language and see if you have the ability to be reimbursed for borrowing costs with your current sign-up language that you have with your clients. And if you don't, I highly recommend you give us a shout. We will send you for free some sample fee agreement language. It doesn't mention us. You never have to be our customer. We'll send it to you for free. Consider changing your fee agreement language today. The reason being that it costs you nothing and it starts to leave options open. And Jeff, we have firms who don't change it and come sign up with us, and it's a little tougher for them to come on board.
Well, pre-disclosure is the key. And no one wants to feel like they're baiting and switching the plaintiff. The plaintiff is in a very typically rough spot, and they're relying on the firm to really advocate for them and resolve the case and get justice and make sure that justice is served. It takes a little bit longer because we call that starting from scratch, where if a case typically takes 12 or 18 months to successfully litigate, our client will typically not incur a tremendous amount of costs, for that case, maybe until the last 6 months of that case's life cycle,
or even 6 weeks.
So it can take some time. Now, for those clients that have updated their fee agreement language with pass-through, we'll ask a very simple question to say, okay, so how much do you have invested in your cases today? Well, I have $500,000. Okay, well, if you were our client, we could have that $500,000 potentially in your operating account 24 hours after initial funding. Then imagine the other areas of your practice that $500,000 could benefit. Imagine, boy, what a great day would it be to go home to your family and say, hey, guess what, guys? We just recovered a lot of our own money.
Yeah, exactly.
Yes.
Fantastic. Again, for our viewers, let us know if you'd like a sample of fee agreement language. We also have a couple other documents to help you. We think that an educated consumer is the best consumer. So a couple tools we'll put in your hand for free. One is called Questions to Ask a Case Expense Lender. So this is a Word document that you can use to investigate in the marketplace potential solutions, make sure you're selecting the best vendor for you. We also have a checklist of sorts in Excel where you'll be able to enter answers to those questions side by side and help you navigate to the best solution for your law firm. Let's talk about an example here, Jeff, which we put together, an example of using a loan with pass-through versus self-funding. Now, this chart might look a little familiar. The bottom line, the dark line, is kind of that line we saw before, which is what is the value of your $1 million invested at zero, basically your after-tax cash over time? What's the buying power? And over time, it drops by about 1/2 with current inflation rates. The top line shows what it could be, right? So if you took that $1 million out and you invested it in making a modest return in stock market type returns, you could end up with twice as much buying power over time. So the difference between the end lines there is actually a factor of 4, if I'm doing my math right.
Yeah. We've had clients tell us at trade shows, for example, that the $1 or $2 million they have invested in their cases, that is their safety net. That is my retirement, is what one firm said to me. And I said, well, I mean, that's great. Imagine what that money, I asked, how long until you retire? And 10, 15 years. Yeah. Okay, well, that's really great. Boy, I wish I could retire in 10, 15 years. That'd be awesome. But imagine how long will it take you to recover your own money?
Yeah.
Because you'll recover that money as your cases resolve over time. And then secondly, imagine what that $1 or $2 million would be worth today if you invested it now. The markets are very strong, as we mentioned earlier. Getting in on that with a modest rate of return 10 years from now,
right.
You would just have to look at the differences in those two lines and
see where you could be.
And it's really the appreciation. If I would go to my financial advisor and I handed him a check for her a check for $1 million, and they said to me, Jeff, we've got a really great investment strategy for you, and we're going to pay you $0, but we'll be more than happy to take your money so that when you're ready to retire, this is what you'll have. I would not.
You'd fire them.
Yes.
Right. So the difference between these two lines is one of the opportunity costs of self-funding. So let's do a quick recap. Here's a summary of the sources by purely economic effective annual interest rate. You can see fee sharing at the top, all the way down through loan with the interest pass-through. Now, when you're capitalizing your law firm, you want to try to work your way toward the bottom of this list to the more effective, less expensive capital. If you find yourself using the products up near the top, third of this list, you might want to get some help from a business advisor. Look at your business model, look at your expenses, and see why are you accessing capital that's so expensive. One of the difficulties in this business also is that the insurance companies, who are typically on the other side of the courtroom from our clients, have very low cost of capital because they're just taking in premium payments all day, every day, right? And what are they paying back for that? Many times nothing, because I've been a State Farm customer for longer than I care to admit, and I think I've filed $1,000 claim maybe in 30 some years. So they have a good return, they have a good cost of capital for me.
There are a lot of market players, whether it's a bank or some of the very large finance companies that would operate in a very similar fashion than one of the large insurance companies.
Right.
In terms of a very large super regional or national institution, if they change focus, because they're subject to the regulatory environment that banks are subjected to, if they decide to change course, very often our clients are left holding the bag because now all of a sudden the bank has said, well, we're not actually going to be doing loans like this any longer.
Right.
And it can provide a struggle.
Great. So you might be watching this asking, well, so what? I'm not in it for the money. I'm in it to help people. Well, the reality is it's about you being the keys to the courtroom for your clients. And if you don't manage your finances as effectively as you can, you're just not going to be able to get the same results as you would be able to if you had access to more efficient forms of capital. So For you plaintiffs lawyers that are watching, thank you for the work that you do in your community. Thank you for being willing to step out and put forward your time and energy and sweat and heart and soul in addition to your capital to get results for your clients. And we hope that if at some point we might be able to help you. So right now we're going to open it up to questions. If there are any questions, we'll wait for just a moment to see if any come in. We'll give you a chance. You can type them in the questions box, and we'll wrap up. So Jeff, you've been with us for how long?
It'll be 5 years.
Yeah.
It's like yesterday.
Yeah, doesn't it go fast?
It does go fast.
Yeah, and I think I think our business has more than doubled since you came aboard. So thanks for being part of that. Okay, what does Advocate Capital's services cost? Well, we won't get into details here. There are three components. One is the interest rate at prime plus 3. There are a few other charges. So go to our website, do the chat. We'll put you in touch with your advisor in your particular state, and they'll walk you through and disclose the terms. And we're really good about disclosing terms. We'll give you our sample terms, which will match our terms sheet, which matches our loan documents in case you have any questions. Okay, hang on a second. I'm having trouble reading this one. Do we work with startup law firms, or is there a history requirement? We do sometimes work with startup law firms. It's more difficult because the underwriting committee typically is looking at a track record. So if certain things are present, we can sometimes work with the startup. We're looking for someone who's not right out of law school, right? So they're going to have a track record, probably as a partner at another law firm, and ideally be able to document from that law firm, here are the fees I generated inside the law firm, and we'll be looking also at their personal tax returns. We're going to look for a higher net worth than usual, and we'll probably be kind of conservative on the line size, and we'll require excellent credit, probably a 720 or higher credit score, something like that. But we do fund startups from time to time, so get in touch with us via the website. We'd be happy to speak with you. Okay, what is the collateral for Advocate Capital? The only collateral we require is accounts receivable of the law firm, so we don't file on all assets. We're not going to file a lien on a lawyer's house. We're going to file a blanket lien, one lien on accounts receivable, and it's not case specific. It's just all accounts receivable for the law firm. Okay, is Advocate Capital recourse? We are full recourse, so we are on the low cost end of the spectrum, which means we're on the low risk end of the spectrum. So all of our loans are full recourse. We don't do the non-recourse lending. If we did, we'd have to charge 100% interest rates.
Mike, if I could add,
Sure.
When we've had clients ask that before, the question is, well, so if you self-fund today and you lose your case, what happens to your money? Well, unless you're collecting it from the plaintiff, that money's gone.
Right.
In our example, if it's our money that's on the line or at risk, and it speaks to the point of doing everything that a firm can do to de-risk their own cash, we can provide a law firm with options at the end that they wouldn't have if their own money was gone.
Right, absolutely. So, okay. Well, I think that's it. Folks, if you have other questions, visit our website. We have a live chat. We can put you in touch with Jeff or a member of his strategic solutions team. They are dedicated to your success, and we find the happiest customers are the ones who will allow us to come alongside, hear what their goals are, and custom kind of tailor our solution to help them get there. So I think we're going to wrap up. Thank you so much for joining. Greetings once again from Music City, Nashville, Tennessee, and we hope you'll join us for future webinars. Jeff, thanks for being here.
Appreciate it. Thanks, Mike.
Thanks for watching. Send your questions or comments to Michael at mike@howdavidbeatsgoliath.com.